Every time you pay your mortgage, buy groceries, or cash your paycheck, your wallet is tapped into a complex global system, the United States economy. For months, watching those daily costs climb has been the defining frustration and the primary concern for American families. But recently, that momentum shifted. The latest data in 2026 shows inflation is finally easing up, offering consumers relief at the checkout counter. This cooling is the visible result of the deliberate economic tug-of-war happening behind the scenes. Right now, the prices you pay are dictated by an active equilibrium between two opposing market forces. To understand why things are finally cooling down, we have to measure the specific weights pushing and pulling on this precarious balance. The question is, what deliberate strategy is managing to outweigh capital-intensive new market pressures to successfully drag inflation down? The primary downward force pushing against rising prices comes from the Federal Reserve. Their primary mechanism for controlling inflation is keeping interest rates at relatively high levels to restrict the broader market. When the Fed holds these rates high, it directly increases the cost to borrow money. Everything from a family's new mortgage to a corporation's business loan becomes more expensive to finance. This added friction slows down consumer spending, which reduces overall economic demand. This policy also intentionally impacts the job market. While recent labor data shows the hiring remains stable, it has distinctly slowed from the highs we saw previously. By making borrowing harder and spending less attractive, the Federal Reserve effectively starves inflation of the demand it needs to grow. But if the Fed is pulling so hard on the economy, why hasn't the inflation problem vanished? The answer is artificial intelligence. The AI boom is acting as a powerful new counterweight, threatening to push costs right back up in 2026. Tech companies and enterprise businesses are currently injecting hundreds of billions of dollars into capital-intensive AI infrastructure projects. A major target of that spending surge is the rapid construction of these facilities, large-scale, energy-intensive data centers needed to house thousands of servers. The other major investment goes directly into these highly complex silicon wafers, which are the advanced computer chips required to train wide-scale AI models. This localized corporate spending boom creates a fierce new demand for electricity and hardware, causing new upward inflation pressure in specific sectors. The relief consumers feel at the store is a result of the Fed's downward pressure managing to counteract these significant upward costs from the tech sector. This line graph shows the ongoing reality clearly. While inflation is trending downward, it is still hovering above the Federal Reserve's long-term target rate. Because this balance is precarious, financial markets obsessively watch key economic signals to anticipate any sudden shifts in momentum. These signals form an early warning dashboard for the economy: corporate earnings reports, consumer spending metrics, and the latest labor data. Tracking these specific data points reveals exactly which way the macroeconomic scale is tipping at any given moment. Ultimately, the U.S. economy is a constantly shifting ecosystem, not a static environment. That means there is no need to react impulsively every time a minor economic fluctuation or new headline flashes across your screen. By understanding the larger mechanics at play, like how high interest rates are being used to counter a tech boom, you can make informed, long-term decisions for your personal finances. Seeing that bigger economic picture allows you to separate the daily market noise from the true signals that actually affect your money.